All right, well, good morning, everyone. As Grant said, I am Jenny Wisdom. I've been with TRS for almost 20 years. I have gained a lot of knowledge, but there is always stuff that's changing. I learn something new every day, just like you guys learn something new, so hopefully you'll get a lot out of this. We haven't had a lot of legislative changes that impact this current reporting year, so we're kind of going to do, once again, we're going to do a broad overview of all things TRS. The budget signed by the governor this week will not impact the 2017-18 reporting year. So like Grant mentioned, he's going to do an overview of what little we do know about the legislative changes that will start with the 2018-19 fiscal year. This will hopefully be a good refresher for some of you seasoned bookkeepers that are not new. Those of you that are new, it's going to be a lot of information, but we hope that you gain a lot out of it. We want this to be informal and interactive, so please, if you have questions, raise your hand. We'll get your questions answered for you. We're also going to have questions coming in, hopefully from the internet, that we will be able to answer those as well. Everyone should have a handout of today's presentation. And you're going to notice that some of the slides reference the chapter in the employer guide that you can find the information we will be discussing. Everything that I talk about today can be found in the employer guide. This is available on our website if you don't already have a printed copy. And it is a great reference tool that we encourage everyone to use. So we're going to start out talking about the requirements to be a member of TRS. There are several requirements that have to be met in order to qualify as a TRS member. A person must hold a valid Illinois teaching license, and that license does have to be registered to be considered valid. The person must be employed in a position for which the Illinois State Board of Education requires teacher licensure, and they must be employed by a TRS-covered employer. So for instance, if you're paying a licensed employee for performing work that does require licensure, but you're paying them through accounts payable, that's still going to be reportable to TRS. If they hold that licensure, they're still reportable to TRS. If you're paying that person through a third party, like if you're contracting out for a speech and language pathologist, you would not report them because you're not paying them directly, you're paying their employer for their services. It is not optional to participate in TRS. If the requirements are met, it's mandatory. You have to contribute, you do have to participate in TRS. If you have a member that changes positions, goes from a licensed position to a non-licensed position, they no longer are a member of TRS once they are in a non-licensed position. An example would be a paraprofessional. You may have a paraprofessional that actually holds a teaching license, but if they're working in a non-licensed position, that doesn't qualify them for TRS membership. It actually qualifies them for IMRF membership. The state board determines licensure requirements, not the individual school district and not TRS. Normally, if you're unsure of whether or not a position requires licensure, we do have a list in Chapter 2 of the Employer Guide that shows positions we know require a teaching license, and then it also shows positions we know that do not require a teaching license. If the position you're questioning does not fall in one of those two lists, what we suggest that you do is email the job description to the Illinois State Board of Education. We've got the email address here. It's compliance@isbe.net. You can ask them to review the job description to determine if teacher licensure is required. If they come back and say yes, then the person will qualify for TRS membership. If they say the position does not require licensure, it wouldn't be anything that qualifies as TRS. Quite possibly, it would probably be IMRF then. If you get an answer back from the state board and it's not what you expected, if you were expecting the position to require licensure and they come back and say that it does not appear to require licensure, there really is no true appeals process. But what you can do is you can make some changes to the job description. So any changes that you want to make, you can resubmit it and have them look at it again, and they'll take another look. And possibly changes to that job description could make them change their mind on that as well. Your non-contributors to TRS, this would be any non-licensed employee, so anyone who does not hold a current valid teaching license. Teachers who are employed in positions not requiring a license, which I gave the example earlier as teachers' aides or paraprofessionals. Or if you have any retired TRS or CTPF, which is the Chicago Teachers Pension Fund retirees, who have not exceeded the post-retirement employment limitations. The post-retirement employment limitations, in order to be eligible to retire, a member must terminate active service as a teacher. To satisfy this requirement, the member has to formally resign their position. They have to wait at least 30 calendar days before returning to the same employer, and they cannot prearrange any post-retirement work. We can't stop people from talking about it, but do not let any of your members put in writing that they're going to return to work for you after retirement, prior to their effective date of retirement. Members that have established termination of service, they also cannot return in the same school year that they last contributed. So if you have someone that retires in December, they're not eligible to return to do any post-retirement work until at least the following July 1. So they have to wait until the next calendar year. Once a member retires, he or she is limited to 100 days or 500 hours, and that is per school year. So that's per July 1 through June 30th. That count does start over every school year. Only licensed work counts towards the limitation. Retirees can work in a non-licensed position without limit. So if you have a retiree that is a coach, that does not count towards the limitations. That is non-licensed work. The only thing they have to count towards the limitation is any work that requires teacher licensure, which would be classroom instruction. It is the annuitant's responsibility to maintain a log of their time worked. You don't know where else they're working. You guys really only know what they are doing in your district. But if you are aware that they are working in your district and they could possibly exceed the limitations, you do need to notify us if you know that that is going to occur. So what happens if they exceed the limitations is they become an active contributing member on the 101st day or the 501st hour, and their pension stops. As far as counting, we have a lot of questions on how do I count? Do I count by days or do I count by hours? It really depends on the schedule that the member is working. If they're working full days, and by full days we mean 5 or more hours per day every day that they're working, they should count towards the 100-day limitation. If they're ever working a combination of full days or partial days, which would be less than 5 hours a day, they should convert everything and count towards the hourly limitation. When counting towards the hourly limitation, the maximum number of hours that you have to count for any given day is 5. So even if they're working a 7-hour day, the maximum they have to count is 5 towards that 500-hour limitation. If they're working less than 5 hours, they just count the actual number of hours worked for that day. So potentially a member could work on more than 100 different school days, but still be under the 500 hours, and that's fine. Retirees do not pay contributions to TRS. As long as they stay under the limitations, they're subject to state and federal tax and Medicare only. Chicago annuitants are treated a little bit differently. They're treated as a TRS retiree, so they get to work in a TRS position for up to 100 days or 500 hours. But if they ever exceed, they do become active contributing members, but unlike TRS retirees, they're able to keep receiving their pension from Chicago teachers. Their pension does not stop. So it does not hurt them receiving their pension from the Chicago Teachers Fund, but it does with TRS retirees. Once they exceed the limitations, their pensions do stop. There is legislation that has passed to increase the limitations to 120 days, 600 hours. That's been sent to the governor for signature, so he does have to sign that before it becomes law. And I believe if it's like other pieces of legislation, I believe he has 60 days to sign that, to put it into effect. So if that does happen, we will let you guys know right away. It'll go into effect July 1st. And I do not know if it's permanent or if it's just for a temporary time frame. We did have it in place a few years ago. I think it ended about 5 years ago. There was about a 10-year period that it was 120 days, 600 hours. Public Act 96-0889 created 2 tiers of membership in TRS. If a member's first day of service in a TRS-covered position was before January 1st of 2011, the member qualifies as a Tier 1 employee. If a member's first day in a TRS-covered position was on or after January 1st of 2011, and he or she did not have any previous service credit with a pension system that has reciprocal rights with TRS, then that member qualifies as a Tier 2 employee. Right now, we do not treat Tier 1 and Tier 2 members any differently. They pay the same contributions. There's no difference in the way that you treat them or report them to TRS. The one exception is for Tier 2 members, they actually have an earnings limit. And the earnings limit for this fiscal year is $113,644.91. So if you have anyone that's Tier 2, once they reach this limitation, any earnings they have beyond this number, you do not pay contributions on that. So they only owe contributions up to $113,644.91. The cap for fiscal year 19, we don't normally find that out until November. That is determined by the Department of Insurance. So as soon as we do find out the cap for fiscal year 19, we'll let you know. But it's normally after the beginning of the school year. So it's a couple of months into the school year before we find out what the cap is. This last summer, we had another public act passed. It was Public Act 100-0023. This created a third tier of TRS membership. We have begun the complicated process of creating a new hybrid benefit structure for future members, which is what Tier 3 is. It's introducing a defined contribution plan aside from our defined benefit plan. It's new, it's in the works. In order for it to be rolled out, there's a trailer bill that needs to pass due to current inconsistencies with the bill. As far as we know, that's not really moving along too fast, but once that gets to moving, there will be changes coming along with that. One of the changes that we are going ahead and moving forward with to help implement this Tier 3 is we're going to be changing to either a monthly or pay period type reporting. So versus the yearly reporting, we're going to go towards monthly or even pay period reporting. We're just in the beginning phases of that. We're starting to determine what kind of a program that we're going to have, but that is going to be happening in the next couple of years. So stay tuned for information on that. So as of right now, there's nothing that you guys have to worry about with Tier 3, but just keep in mind that there's going to be a lot of changes coming in the next few years. Question? Yes, hold on just a moment. We'll get the microphone to you.
So the rule about anyone first working after January 1st, 2011, is that just for your district, or is that working with TRS at all?
Okay, so the question is, for anyone that is working for the January 1st, 2011, the Tier 1 versus Tier 2 qualification, it's based on establishing membership in any pension system that's reciprocal with us. For example, IMRF is reciprocal, Chicago Teachers Pension Fund, State University's retirement system. You have to establish service in one of Illinois' pension systems or reciprocal systems to be considered Tier 1. It doesn't have to be TRS. Any other questions? Okay, whenever you have new members or new employees that you employ with the district, there are a couple of forms that need to be completed and sent into TRS. The first form is the Member Information and Beneficiary Designation form. We do ask that you use our form. I know some payroll software systems have their own form that it has created, a membership form, but please use our form. We have made changes to it. It was updated last August. With the MIBD form, members are required to show proof of birth, so they have to have a form of identification that they file with that. If you don't have that form of identification, it's okay. You can go ahead and send it in without it. But a member will not be able to collect on any type of benefit until we receive that from them. They have the ability to upload that information from their member account. So if they have a member account set up, they can actually upload a copy of their birth certificate, a driver's license, or a passport, for example. We do have to have a signature on this form. If you use the form that's online, it's actually fillable. So from our website, it's form fillable. They can fill it out online, they can print it out and sign it, they can turn it into the district. You guys can keep a copy for your records and send one in to us. Or you can print them out and let them handwrite their signatures or handwrite their information. The problem we have with that is sometimes we have a hard time reading their handwriting, and we can get some Social Security numbers wrong and some information wrong, but we will find that and we will get it fixed if that does happen. And we do ask that you send these forms to us immediately and don't hold them until the end of the year. This form is what establishes their service credit, creates an account for them on our system. So the sooner we get that prior to you filing the annual report, it's more helpful for us. We can get information out to them. You guys also, if you don't send them in and it's a Social Security number we don't recognize, when you're completing the annual report, you're going to be required to fill out their address information for us at that time. The second form is the Social Security Administration Form 1945. This form is actually administered by the Social Security Administration, but TRS is required to keep a copy of it on file here in our office. This form simply is just something that they read over. It informs them that due to the windfall elimination provision and the government pension offset, that it could impact their Social Security benefits at retirement time because they are contributing to a pension system. So it's an informational form. There is a link to that on our website as well to get that form and print that out for your members. Anytime you have someone that needs to update their name or change their address on file with TRS, we actually have forms for that on our website as well. You guys, as of right now, do not have the ability to make any name changes or address changes for your members. That's something that we're hoping to give you more control over with when we move forward to the monthly or the pay period reporting. But as of right now, members have to get online to update their name or address. They may even be able to call in and do that as well. These forms, we prefer that you mail or fax them to us, or you can even use the secure upload in our employer access area. I don't know if you've noticed when you log into your account from the left-hand side menu, about 2/3 of the way down, there's a secure upload feature now. So any sensitive documents that you have, anything with Social Security numbers that you want to send to us, you can use the secure upload versus emailing it. We prefer not to get emails with anything that has Social Security numbers in it. So we have any questions on membership that you guys can think of? Any questions that came in yet on the internet? Oh.
How is the employer to know if the employee has credit with another system? I have some that have enrolled in IMRF that never knew they were enrolled at a previous job.
Okay, so the question is, how do we know when someone has service in a different pension system to know if they're Tier 1 or Tier 2? You guys probably won't know that. If they have a record established with TRS, within the employer access area, there's actually an employee information lookup section that we added a couple of years ago. You can enter a member's Social Security number. It's under employee lookup, and it's going to tell you whether they're Tier 1 or Tier 2, and it's going to tell you yes or no on whether they're retired. If we have them in our system, we can tell you right away. If they're not in our system, so if they're new to TRS, it takes a little bit of time before we know if they are Tier 1 or Tier 2. So basically, you have to report them on the annual report. That annual report has to come in. We have to do our processes, and we do something that's called a tape match with the other pension systems in the state. That tape match then tells us if they're Tier 1 or Tier 2. So it does take a little bit of time, but if they've been reported on your most recent annual report, for instance, your 2016-17 annual report, you can actually go out there to the employee information section and you can run Tier 1 and Tier 2 reports. And when we get to the employer access area part of that, I'll kind of show you where you can do that from. Is that the only question we had? All right, we're going to move on to creditable earnings. So this is a pretty big chapter in the employer guide. This covers the whole chapter 3. It talks about what qualifies as creditable earnings, what doesn't qualify as creditable earnings. And I'm going to touch on some of the more common examples of reportable compensation. Of course, contractual teaching or administrative salaries, those are reportable as creditable earnings, as well as wages for substitute or homebound teaching. So if you have a homebound teacher or your substitutes, those earnings are reportable as creditable earnings. Extra duties. Extra duties we treat a little bit differently depending on the person's employment with the district throughout the school year. So extra duties that involve the supervision of students or that are related to the academic program, they are reportable for all of your full-time or part-time contractual teachers. Now those full-time and part-time contractual teachers don't have to be employed in your district. They can be employed in a neighboring school district and just be doing an extra duty for your district. Those earnings are still reportable to TRS. So if you employ a coach that's actually an employee of a neighboring school district, the coaching earnings are reportable by your district. For substitutes or part-time non-contractual, which are hourly employees, they do not pay TRS on any non-licensed extra duties. So a non-licensed extra duty, again, would be like club sponsors, class sponsors, coaching duties, detention duty, anything that doesn't require licensure to do that work. Subs and hourly employees do not pay TRS on those earnings. Now, if it's a certified extra duty, a licensed extra duty like behind the wheel for driver's education or for homebound teaching, then that is reportable for anyone that does that work. As far as summer school is concerned, summer school is basically reportable to TRS, but it's reportable. The one thing you have to remember with summer school is you have to report it on an accrual basis. That means the earnings are reportable in the year that the work is actually performed, which may not coincide with the year that you're paying them for the work that they are doing. So any work done in June of 2018, this month through June 30th, is reportable on this annual report, even if you don't pay it to them until after July 1st, okay? So it's reportable in the year that the work is performed. Something else with summer school, as far as the duties they're doing, it follows the same rules. If it's licensed work, it's reportable for anyone. If it's non-licensed work, such as some kind of a summer camp, it's only reportable for your full-time or your part-time contractual teachers. So it follows the same rules as what you would follow during the regular school year. Whenever you do have someone that does certified or licensed summer school work, remember those additional days count. They have to be reported to TRS. So if you have a 180-day school term and they're doing 10 days of summer school in the month of June, you're actually reporting 190 days as their contractual period and 190 days as their days paid on any supplementary report or annual report that you have to complete. The last one here on this slide, gift cards. This came up last year. We pointed it out to employers and there was a lot of surprise reactions from everyone that if you are giving gift cards to your employees in lieu of payments that qualify as salary, the value of those gift cards is reportable as creditable earnings. And it does have to be reported on an accrual basis if it is given for work performed. If the gift cards are given as a bonus, then you have to follow our lump sum reporting rules, which means it's reportable in the year it's paid for your active teachers. If you have a terminating teacher, the payments are reportable based on the timing of the payment. If it's paid prior to or concurrent with the later of their last day of work or their last paycheck, it's reportable as creditable earnings. If it's paid as a post-termination or a post-retirement payment, it's not reportable to us. So a couple of examples. A gift card given as a bonus for good attendance, that's reportable as creditable earnings in the year it's paid because it follows the lump sum reporting rules. But then if you have a gift card that's payment in lieu of, say, internal substitution, that's actually in lieu of work that they performed. So that has to be reportable in the year they actually did the work. I have a question back here.
Like Phil Donahue, aren't I?
So on the summer school where you say we have to report the days, if it's less than 5 hours a day, does that count as a day?
Yes, good question. So the question was on the summer school, whenever I said that you do have to count the additional days worked, the question was if it's less than 5 hours a day, how do we count that? We do not give partial day credit. We only give full day credit. So regardless of the number of hours worked, if a person is doing licensed work, then it's a full day of service credit for them. So if summer school is only 4 hours a day, you're giving them 1 full day of credit for that. Good question. Yes, I've got another question that came in. Oh, a couple of questions.
If an employee already has filled out an MIBD form at another school, do I need to have them fill out another one at my district?
Okay, so with that, with the MIBD form, should they...
They're having trouble with this mic, so...
Yeah, I'm going to repeat the questions because I can't hear it myself. So, all right, the question is, if I have a new employee that's already completed the MIBD form with their prior employer, do they need to fill one out again? No, not necessarily. It doesn't hurt anything to fill it out because there could be some information that has changed. They could have a different name, they could have a different address, or they may want to update their beneficiary information as well. So it's not necessary, but it's always a good idea to go ahead and have them fill it out. Same thing with the Social Security form. It's okay if we have numerous ones of those on file too, because it's not your responsibility as an employer to keep track if they filled them out with prior employers. I would go ahead and just have them fill it out with the new employer as well.
What about the new bill that will allow people with associate degrees to substitute? Would their compensation be reportable?
Well, that's a good question. I'm not aware of the new bill actually I think I've kind of heard a little bit about it, but we don't have any information on that. The question is if there's a new bill that allows individuals with an associate's degree to substitute, which I know that there has been talk about teacher shortages and substitute shortages, and they were trying to find ways around it so it wasn't so expensive for individuals to get a license in order to sub. I know now we allow individuals that have a bachelor's degree, I believe, with a paraprofessional license, they can sub in a licensed position. So when we find out more about that, we'll let you know. We're actually going to keep track of that, your name And does it give the names on there of who's sending the email? Okay, we'll let you know when we find out more information and get back to you on that with that question, because I do not have an answer right now. That's legislation that we haven't heard anything about yet.
If they do summer professional development, are we supposed to add these days to days worked?
Okay, the question is, if it's summer professional development, do we add the days? My understanding is if professional development is their job, so it's what they do every day, they're a contractual employee doing professional development, then the additional days count. But if it's professional development just done on an as-needed basis, that's actually not work that requires licensure. So the earnings are reportable, but you don't have to add the additional days.
Are wellness gift cards considered reportable compensation?
Wellness gift cards. The question is, are wellness gift cards considered creditable compensation? Well, I think we've had that. I'm going to say no on that, because with the wellness gift cards, that usually has to do with some kind of a health program, a fitness program. So it's in lieu, or it's an incentive for them to basically get healthier and either join a gym or join some kind of a program to get healthy. So with those, that's not the type of gift cards we're referring to. We are referring to the gift cards in lieu of something that qualifies as salary. So the health reimbursement type items wouldn't qualify as salary.
We give our employees gift cards as a retirement gift. Does this need to be reported as salary?
Yes. The question is, a district gives their employees a gift card as a retirement gift. It depends on the timing of the payment. Since that's more of a bonus, if the gift card is given prior to or with the receipt of the later of their last day of work or their last paycheck, then it's going to be reportable as creditable earnings. If you give it to them post-termination or post-retirement, after their last day of work and after the last paycheck, no, you do not have to report that as creditable earnings. All right. Next screen here. All right, orientation days. Some districts pay for new employees or even some of their seasoned employees. If they have to attend orientation days at the beginning of the school year, it's not part of the regular school calendar. Those days paid are actually reportable for service credit as well as the earnings for the orientation. So if you do have orientation days, the days and the earnings are reportable. Contributions to tax-sheltered annuities. If the district contributes to a tax-sheltered annuity in addition to salary for anyone, that's reportable as creditable earnings. We normally see that with administrators. They have in their contract that the Board of Education will make a contribution on their behalf to either a 403B or a 457B plan, for example. That is reportable as creditable earnings for those members. If anyone has a flexible benefit plan, a flexible benefit plan, TRS's definition of a flexible benefit plan is when an option that qualifies as salary, for instance, cash or a tax-sheltered annuity, is offered in lieu of taking board-provided health insurance. So if your district allows employees to opt out of taking health insurance and get a cash stipend or get an amount contributed to a tax-sheltered annuity, that is a reportable flexible benefit plan. The thing to remember with flexible benefit plans is it's reportable for everyone with the option, regardless of which option they choose. So that means it is reportable for your insurance takers as well as those that actually receive the cash or the annuity. If you do have a flexible benefit plan, we ask that it be clearly and specifically written into contracts and collective bargaining agreements. As we're doing field audits, we're finding that it's not clear. It's usually clear in a collective bargaining agreement for the teachers, but it's not clear in administrators' contracts. So if your administrators are offered the same benefits as your teachers, it needs to be clearly written in there that they also have that cash or annuity option in lieu of insurance. Or if your administrators have it but your teachers don't, you don't have to offer it to everyone. Some additional reportable compensation. If your employees are using their accumulated sick, personal, or vacation days, whenever they use those, that's reportable compensation to TRS. Lump sums and severance payments. I kind of talked about lump sum reporting with some of the questions that we have. Usually, typically, this includes bonuses, longevity stipends, payment for unused sick leave, personal leave, or vacation days. That's what we recognize as severance or lump sum payments. If they are an active teacher, as I mentioned earlier, it's reportable when it's paid. So if you're paying unused vacation days to your superintendent that may be for FY18, if you don't make that payment until July, it's reportable in fiscal year 18-19. So it's reportable when it's paid if it's an active employee that you're paying it to. If the person is terminating, this is when it depends on the timing of the payment on whether or not it's reportable or not. So in order to be reportable as creditable earnings, it has to be paid or due and payable to your members prior to the later of the last day of work or their last paycheck. Normally they receive their last paycheck after their last day of work, so that's the date you go by. Any payments made after both of those, they're not creditable, and they're also not subject to any 6% costs. So keep in mind with the gift cards as well, if you're paying gift cards and they're going to be reportable, that would be subject to any 6% costs as well. Okay, question.
If your district reimburses for high deductibles, does that count as credible earnings?
If your district reimburses for high deductibles on the insurance, no. Anything that has to do with health insurance related, that is not creditable earnings. Health insurance and any kind of health savings accounts, I think there's HRAs, any kind of reimbursement plan on health insurance, that is not creditable earnings.
Orientation days. The pay is reported, but are the number of days added to the teacher's contract as days worked?
Yes, the question is orientation days. I'm going to flip back to the screen before. Orientation days, and it says here at the top, the days paid are reportable for service credit. So the days get reported as well as the earnings. So both are reportable for orientation days.
If our summer professional development is required, do we report the day to attend to TRS?
Okay, I'm going to assume the question is if the professional development day is required. I assume by required they mean required to attend. Do they report the days? No. If it's a professional development day, it's like a workshop day that they're attending, that does not require licensure. So the day is not reportable, but the earnings would be reportable. The only time professional development is reportable if that is their everyday job and they're contracted to be the professional development coordinator, that is where you would count the days as well as the earnings to TRS. Was that it for questions? Okay. A couple other bullet points here. Employer paid 2.2 or optional service costs. If your district pays on behalf of a member their 2.2 cost or any optional service costs, optional service examples would be purchasing a leave of absence, purchasing service in Illinois from another state. That is reportable as creditable earnings if the employer pays that on their behalf. Board paid member TRS contributions. Any portion of the 9% member TRS contribution paid by the employer is reportable as creditable earnings. How many employers here do you pay at least a portion of the 9% for someone at your district? Okay, I think we have a lot of districts that do that. This causes a compounding factor that you must use when you're paying any portion of the 9%. We do have a table of factors on page 17 of Chapter 3 of the Employer Guide. As long as you're paying the same amount, the same contribution amount, the factor does not change. So if you're always paying 9%, that factor does not change from year to year. It stays the same. The factor for 9% is 1.098901. If you're paying a percentage that doesn't appear in the table of factors in our employer guide, give us a call and we'll actually calculate what your contribution factor would be to use to arrive at creditable earnings. Okay, just a second. All contributions are calculated on total creditable earnings, so keep that in mind as well. All of the contributions you pay into us is base salary plus the board paid TRS factor. Okay, I have another question.
If you have a capped Tier 2 member, once the member reaches that credible earnings wage during the year, do we stop TRS benefits and deductions?
Yes, okay, so the question is if you do have a Tier 2 employee and they reach the cap, the $113,644.91, yes, you stop all contributions after that point. They only owe contributions up to that cap. Any salary earned above the cap, no contributions to TRS are due on that. Okay, we're going to move on to non-reportable compensation. So the next list we have here on the screen, these are all items that do not qualify as creditable earnings and should not be reported as part of anyone's salary. Expense reimbursements and allowances. Examples would be cell phone reimbursement, any kind of travel reimbursement or allowances, or any kind of dues or tuition reimbursement. Those normally are paid through accounts payable. I know sometimes travel reimbursements we see run through payroll. You have to exclude those from the creditable earnings you're reporting to us. Same thing goes with employer-paid fringe benefits. This would be anything, any kind of insurance benefits, including health, life, dental, and disability benefits. If you're paying that on their behalf, it's fine. It's just not reportable as creditable earnings. I've also seen in a couple of field audits this year that employers are starting to run insurance benefits through payroll as part of gross salary because of the Affordable Care Act and the potential for a Cadillac tax. So that would be a tax on anyone that receives higher benefits than other employees at the district, so administrators. If you run that through payroll, you still cannot report it as part of creditable earnings. You have to exclude that when you're reporting creditable earnings. So no insurance, even ran through payroll, can be reported as creditable earnings. Board-paid THIS contributions. If the employer pays the member THIS contribution in addition to salary on your member's behalf, that is not creditable earnings. So the only contribution, member contribution paid on a member's behalf that is creditable is the 9%, not THIS. It's okay that you pay it as a benefit, but you do not add it back in and report it as creditable earnings. Salary conversion. Salary conversion occurs when in the last 7 years prior to retirement, TRS will presume that any decrease in non-creditable compensation is basically converted to creditable compensation for the purpose of increasing someone's final average salary. Now that is a complete mouthful, and everybody usually has a blank stare as, what is she talking about? Basically, as an example, what that means is if you have a superintendent that's offered a flexible benefit plan with a cash option instead of just getting health insurance, so if before your superintendent had health insurance only, and that's going to be changed to a plan where they can opt out of insurance and take it as cash, you're taking something that isn't reportable, because health insurance by itself is not reportable, but you're converting it to something that becomes reportable compensation, because a flexible benefit plan does qualify as creditable earnings. It is reportable at the time, so you don't have to do anything different with reporting, but if they retire within 7 years of that change in compensation structure occurring, we're going to go back at retirement time and disallow that amount from their pension benefit calculation, okay? So if you ever get any phone calls when we are reviewing the supplementary reports asking about large increases in salary because we see jumps in their salary, we're trying to determine if something like this occurred. So that's something that we keep a lookout for on our end. Or if we know of this change occurring by way of us reviewing contracts, we'll let you know if this person retires prior to X date, we will apply conversion at retirement time. If they retire outside of that 7-year period, there's nothing to worry about. The salary stays in there. The last bullet point here, settlement agreements, judgments, or contract buyouts. We are seeing more and more of these. If you have any kind of a legal agreement between an employee and the district, we do ask that you email a copy of this or give us a call. We would like to see this agreement and review them. We review them on a case-by-case basis. We're not concerned about the circumstances behind the situation. We just want to see the terms of the agreement. What we're looking for, key issues are a termination date, the characterization of any payments they might receive, and then the date that they're going to receive these payments. And then we will let you know after reviewing the agreements what is reportable, what is not reportable, and sometimes if we have enough information, we'll send you a letter showing you exactly how you need to report them on the annual report if it does impact. So do I have any questions on creditable or non-creditable compensation or anything that we've gone over so far that you can think of? Any more that came in online? Okay, we'll move on to pay period contributions. As I mentioned earlier, all contributions are calculated on creditable earnings. I've got a chart here that shows the 2017-18, the current contribution rates, and then we've also added the contribution rates that are going to go into effect as of July 1 for the 2018-19 school year. So the 9% member TRS contributions, this is used to fund retirement benefits, survivor benefits, and the annual annuity increases. It is an employee obligation, but employers can offer to pay it as a benefit. If it's board paid, it does have to be added to creditable earnings, and it also does have to be tax sheltered. The 0.58% employer TRS contribution, this is also referred to as the MBI, which is the member benefit increase. This is used to fund the increase in retirement benefits as a result of the 2.2 formula that passed way back in 1998 when I started. It does have to be paid by the employer, and it cannot be deducted from anyone's salary. It also does not get added to creditable earnings. It is an employer contribution. There's two THIS rates that are currently in effect. THIS stands for the Teachers Health Insurance Security Fund. These monies are used to help fund the Teachers Retirement Insurance Program, or the TRIP program. A member may never take advantage of the TRIP program in retirement, but they are still required to contribute to THIS throughout their career. It is not optional, it's mandatory. The member THIS is currently 1.18%. We just got word this week, finally, that it's jumping up to 1.24% for FY19. The employer THIS is going up to 0.92%. And again, the member THIS, it is an employee obligation, but if the employer pays it as a benefit, it is not additional creditable earnings. The last contribution listed is federal funds. Federal funds are due on any portion of a member's creditable earnings that's paid from a federal grant, including sub-pay and extra duty pay. Okay, so if you pay any of your subs or any extra duty stipends out of a federal grant, you do owe the federal fund contribution on those monies as well. Typical federal funds include Title I, II, III, Title IV, Title VI, IDEA flow-through, and then we also see the Carl D. Perkins Vocational Educational Act as well. The 10.10%, which finally we have good news that it's no longer 40%, the 10.10%, this isn't due in addition to any of the other contributions that you pay. It is strictly an employer contribution, and it can never be paid by the member or deducted from their salary. And we do ask that the business office keep your grant administrators updated on the federal fund rates, and I'm happy to say that next year it's finally dropping. So every year, hopefully, it'll maybe go down a little bit. So for 2018-19, it is going to drop to 9.85%. So ensure that your grant writers are aware of this and that they're using the accurate percentage. The due dates for your contributions, this depends on your payroll dates. So any payrolls paid or issued between the 1st and the 15th of the month, you have to have the contributions to us by the 25th of the month. Any payrolls issued between the 16th and the last day of the month are due by the 10th of the following month. And then you have to have all contributions for the year into us by July 10th, which is why a lot of you accelerate your contributions throughout the school year and do not withhold anything over the summer, or other districts run all of their summer payroll checks in June to get the contributions into it and then hand them out on the appropriate pay dates.
Jen,
Yeah.
we don't have a big crowd. Can we take a poll of who does what for the summer months?
Oh yeah, what does everyone, I don't know what the consensus is. How many of you do the accelerated rates? About a majority. What about running the summer pays in June? Okay, seems like I think more districts probably do the accelerated rates. It's up to you. I mean, we do not have any say in what you do. It's up to each individual district what you want to do as far as that is concerned. If you do owe us money after July 10th, because sometimes you have late timesheets turned in or you have summer school programs, you do have an ability to make contribution deposits after the 10th of July. In order to avoid penalty, we ask that you use pay period 60. Okay, so you have a window of July 11th through August 15th to use pay period 60 and not be assessed any penalties for late contributions. The final deadline on that is August 15th. So any contributions we receive for the prior fiscal year after August 15th, those are all subject to penalty. There are several different, actually there's about 3 different types of employer costs that you could possibly owe to TRS. If you are billed for any of these costs, which this is a brief overview of the 3 different costs, and then I've got a slide for each of them to go into a little bit more detail, because this does contain the new employer costs that went into effect for FY18 as part of the Public Act that implemented the Tier 3. If you're ever billed for any employer costs, for any of these three, you're first going to receive a notification letter prior to any of the amounts showing up on your bill. Okay, so you're going to get a notification letter in the mail letting you know you may owe a cost for salaries in excess of the governor's statutory salary, salaries in excess of 6%, or for any excess sick leave days. The notification letter will contain the calculation of how we came up with that amount due as well. You've got a little bit of time to pay these to TRS. If you're billed for salaries in excess of the governor's statutory salary or for salaries in excess of 6%, you have a little bit more time to pay that off. So you can pay it within 90 days with no interest. After 90 days, the unpaid balance does start accruing interest at 7%, and then you do have to have both balances paid to us in full within 3 years. So you have a maximum of 3 years to pay any of these costs. With the excess sick leave days, that amount is due within 30 days of receipt of the bill. There is no extension on that. If you ever have any late period contributions, penalties, or penalties for a late annual report, we're going to bill those to you on your monthly employer bill as well. Anytime you are penalized, assessed any kind of penalty, you can always request a waiver for these in writing. Okay? So if you're interested in how to do that, contact us and we'll let you know. We'll give you an email address of someone in our accounting department that you can always send an email to and ask if we would waive a penalty. If you're not a repeat offender, we're really good about waiving penalties. If you don't get a full waiver, we'll even do partial waivers. So just keep that in mind. Okay, we're going to talk a little bit more in detail on the salaries greater than the governor's statutory salary cost. And now this is new for 2017-18. It was signed into law July 6th of 2017. It's part of Public Act 100-0023. So this Public Act is what established it or created a third tier. And it also established this new employer contribution for salaries that are in excess of the governor's statutory salary. The governor's statutory salary is currently $177,412. Do any of you even have anyone at your district that makes more than this? You do. Okay. So this is something that is going to be billed to you on a yearly basis. What you're going to owe is an employer cost that's equal to 10.10% of the amount of salary that's over the governor's statutory salary. It's going to be determined on a full-time equivalent basis. By that, what we mean is what the percentage of employment with the district is. So if they are a 100% employee, we're charging it on the 100% cost. If they are a 50% employee, so they're only a half-time teacher or administrator, if their 100% salary for being a half-time teacher exceeds $177,412, as of right now, you'll have a cost on that. Even though that's not what you pay them, the cost, the way it's written in the law currently, is that it is going to be due on the full-time equivalent basis. Part of that trailer bill for cleanup for inconsistencies that I talked about earlier does include language to get rid of the full-time equivalency, but as of right now, it's still in there. So salaries for part-time employees, like I said, they're going to be calculated on a full-time equivalent basis. Employers will be billed this cost yearly after the audit of your annual report. Okay, so after we're done auditing your annual report for FY18, that's when you're going to get billed for it. You'll get the cost notification letter showing you how we calculated the cost, and then it will show up on your next month's employer bill. So you're going to owe it in the fiscal year after the year the salary was paid. So for FY18 salaries, you're not going to owe it until FY19. That's how long it'll take us to get it billed. We have sent out a couple of bulletins on this, so if you want more information, I suggest you go back and you can print those bulletins out from our website, or if you have questions, you can always give us a call. We're working on adding examples of this to Chapter 8 of the Employer Guide, so when we get our Employer Guide revisions done, we'll let you guys know. We'll send an email out, and we'll have examples in Chapter 8 of the Employer Guide as well. Question?
If a member is in a multi-year contract, are they then exempt from the governor's salary?
No. The question is, if a member is in a multi-year contract, are they exempt from the governor's salary? No one is exempt from the governor's salary. Anyone that makes more than this, subject to a cost starting this year. No exceptions. I have a question over here.
Like a gazelle.
If you're using a retired superintendent, and they're not going to work over the 100 days, but would they apply that then and make it be that way?
Okay, the question is if we have a retiree, a retired superintendent that we're employing as an interim and they're making more than the salary. No, you don't owe anything because they're not reportable to us. It would only be active reportable members that you would be subject to this cost. Now, if they were to exceed the limitations and go over the 100 days or 500 hours, then yes, you could potentially have a cost on that. Any other questions on governor's salary?
If we are calculating the governor's statutory salary, do we include the TRS reportable earnings, for example, flex plan, retirement incentives, and 9% for the actual yearly salary?
Yes. The question is, what do we include when we're coming up to the governor's statutory salary? It's total reportable creditable earnings, so it's everything. It's base salary, flexible benefit plan earnings, extra duty earnings, any kind of lump sums or severance payments. It's full reportable salary. So that line of information that you report to us on the annual report, your annual salary rate and your creditable earnings, that's what we're looking at to assess or to bill the cost for anything over the 177,412. Any other questions on that? We know that you guys are probably going to have a lot of questions on that for this first year, so please feel free to email us or give us a call if you come up or think of a question after today's seminar. We're here to answer them for you. No question is a dumb question. All right, we'll move on to salary increases greater than 6%. For Tier 1 members, excess salary costs will only be applied to increases that occur in the final average salary years. Your final average salary years are the 4 highest consecutive salaries over the last 10 years. That's for Tier 1 employees. If you have anyone retiring that's a Tier 2 employee, their final average salary is actually calculated on the 8 highest consecutive over the last 10 years. Yes, there was legislation passed a couple of days ago that changes the 6% to 3%. That does not go into effect until FY19. So for FY18, everything is still set at the salary increases greater than 6% before you're billed a cost. The cost is calculated using year-over-year earnings from the same employer. So if you have someone that works for more than one employer, you are never going to be billed any kind of cost for what they earn at that other employer. You're only billed costs based on what they earn in your district. Question?
So you said the 6% is for this year, but if you have the contract still going on, the 6% will continue.
Yes.
That's going to be fun for you guys.
Yes, I know. Okay, so the question is, with the new legislation dropping the 6% down to 3%, what if we're currently in a contract that hasn't expired yet? If you guys were around whenever the 6% came into play back in 2005, we're going to treat it like we did then. So if the contract that you are currently in as of January the 3rd of 2018, you'll be exempt from any costs for salaries over 3% up to the 6% for the life of that contract. So, I'm sorry?
You said January or June.
June. Did I say January? I'm sorry. January the 3rd, so this past Sunday. So yeah, you will be exempt at least for the life of that contract.
But if you have it, do it over 3 years, so if our contract ends in FY19, but
they put in there, yeah,
3 years, then
yeah,
okay.
yeah. So the question is, if we have a contract that expires in June of 2019, June 30th of 2019, we'll say, and someone puts in their intent to retire, and the current language offers a salary increase up to 6% over, let's say, their last 4 years. If they put it in prior to the expiration of that contract, but they're not retiring for, say, 3 more years out, are you still exempt on the cost? My understanding is yes, we're going to allow that, and that would be something we consider grandfathered. Did you want to add something?
Well, I was just going to say, when Jenny's done, we'll go over what we have on the website, which will cover some of this, how we're going to handle the current CBAs and right, those extensions or whatever term you want to use. But yeah, there is certain language in the legislation that allows us to not use the 3% for current CBAs, and then we're going to take it a step further. So.
Okay. As long as someone is paid for at least 170 days, we will use the annual salary rate in the final average salary calculation. The only time we use a different creditable earnings calculation is if the member works at less than 170 days, okay? So if you have someone in their last 4 years or in their final average salary years that has a partial year of service, Be aware of that we calculate the 6% cost a little differently. So you may want to give us a call if that occurs, and we can help you out with that if you're trying to determine what their maximum is without going over. We do have examples of both of those situations in Chapter 8 of the Employer Guide. The third cost you may be billed for is for excess sick leave days. This cost only applies to excess days that are granted during a member's final 4 years before retirement. So we only look at the last 4 years for sick leave days. The normal annual allotment is defined as the amount of sick leave days that are granted to members employed under a collective bargaining agreement or employment policies. This does include personal leave days that can be used as sick leave. If your administrators get more days than your teachers get, those additional days administrators get are subject to the cost. So keep that in mind. Normal annual allotment is what the person would get if they were to fall under the collective bargaining agreement of your teachers. The employer contribution for excess sick leave days will not be required if the sick leave is granted earlier than 4 years before retirement. So if you give extra sick days 5 or more years before retirement, there will be no cost for those days. If a member has been inactive for more than 4 years before retirement, we won't charge a cost. Or if the granted sick leave days do not qualify for TRS service credit. We do have calculators on our website to estimate 6% and excess sick leave costs, so we do suggest that you make use of those if you think you might be in a situation where you would owe. All of these employer costs can never be paid by the member. Okay, these are all costs required to be paid by the employers. You can never charge your members or ask your members to reimburse you or reduce a payment that you owe them by what the employer could be charged. Sick leave issues. At retirement time, members may receive up to 2 additional years of service credit for unused, uncompensated sick leave. This does include personal leave days that are available for use as sick leave. So be sure to report any unused personal leave days in a member's final year. They must be available for use in the event of illness, and the administrative code prohibits granting service credit for days added to the record of a member for the sole purpose of increasing their retirement service credit. So you can't just give a member a whole bunch of days at the end of their career to get them up to the 2 years of service credit. Anytime you're granting additional days over and above the normal annual allotment, you do have to follow a 3-step formula to determine if the days are even going to be reportable to TRS for service credit. I do have the formula here. Basically, the formula says from the date that the sick leave days are going to be added to a member's record, you have to count the number of remaining work days until their termination or their retirement. From that number of remaining work days, you have to subtract off what they already have on record. The remaining difference would equal the maximum number of additional days you could give them. So essentially, this 3-step formula is saying that there has to be enough work days remaining that a member could first use what's already on their record plus the additional days you would want to grant them before we would even recognize them as service credit at retirement time. And only days that meet this 3-step formula then would be subject to any costs. So if days are given to teachers that don't meet this formula, you wouldn't owe any kind of a cost for it because they're not going to be reportable for service credit at retirement time. If you allow your members to retrieve days they've deposited to a sick leave bank, withdraw them at retirement time, we will take those days and recognize them for service credit. Okay? If you do that, we do ask that you reduce the balance, the overall balance of the sick leave bank if you allow them to withdraw them. You don't have to. Each district should set their own policy on that, but those are days that we will recognize for service credit at retirement time. Okay, payout for unused sick leave days. This causes more reporting problems for us on the supplementary reports, probably more than anything else. If a member receives any payment based on sick leave and that payment is reportable as creditable earnings, then the sick leave days used in the calculation are not reportable for service credit. Okay, so if you're making a payment to a member prior to or with their last paycheck where you're going to report the earnings as creditable earnings, you do not report the days that they are paid for. On the other hand, and this is what is more common, if the payment isn't reportable as creditable earnings because you're paying them post-retirement for any unused sick leave days, then all of the days on record are still reportable to us as of the date of their last paycheck. Okay? So since we are never going to recognize any post-termination or post-retirement payments as creditable earnings, all days on record are still reportable. And all days are reportable even if it goes beyond the maximum 2 years of service credit, which is 340 days. So 170 days constitutes 1 year of service credit, 340 constitutes 2 years. If someone has 400 days on record, report all 400 to us. You don't have to cut it off at the 340. If your district does pay post-termination for sick leave days, we get a lot of inquiries on, well, how many days got used for retirement purposes? Your members can actually, after retirement, they can call TRS and request a letter from us stating the total number of sick days not used for retirement service credit. Okay, so that is not something that the employer is responsible for. Your members need to contact our member services department to ask for that letter, and then they can share that letter with you if you want to know how many days were not used so that you can pay them post-termination. You're still responsible for reporting all of those days on record to us. So any questions on sick leave? Okay. We got one more slide here to go over real quick, and then we'll take a break. So granted sick leave days. The following days here on this slide, these are all considered granted days, and they must meet that three-step formula that I discussed earlier before they are even reportable for service credit at retirement time. Unused personal days. If you do not allow your employees to use their personal days as sick leave, those are not reportable for service credit. If those unused personal days that are not available for use as sick leave roll into sick leave if unused, they have to meet that three-step formula, and they are considered granted days, so they would be subject to cost in the final 4 years. Any bonus days awarded for good attendance or for not using days. Does anybody have any language like that in their contracts for bonus days, 2-for-1 days for not using anything like that? Okay, good. Sick or personal days awarded in lieu of payment for extra duties or awarded due to illness. Those are considered granted days. Unused vacation or bereavement days that convert to sick leave. Sometimes we see at administrators' contracts that the language is in there that their unused vacation days will roll into sick leave. You can do that, but they have to meet the three-step formula. So they may not be reportable for service credit when they get close to the end of their career because they don't meet the three-step formula. And those are also considered granted days. So anything in this list, granted days, keep in mind they are subject to cost if this occurs in the last 4 years. I mentioned this earlier, unused personal days that accumulate 2-for-1. It didn't sound like anybody had that language in their contract. Unused business, board, or emergency leave days that roll into sick leave. If you give your employees something equivalent to what a personal day qualifies for, something other than sick leave, call it a personal day in your collective bargaining agreement. Don't give it a funny name or a different name. The law is specific in that unused personal leave and sick leave days are reportable for service credit. It doesn't say unused business, board, or emergency. So if you're giving personal leave days, call them personal leave days. Don't call them something else, or we may not recognize them as part of their normal annual allotment. They may be considered granted days and subject to cost.